I think we are often clear in the messaging that a lot of the macroeconomic and market noise is just that. It's noise. And you build portfolios. Our client portfolios are constructed in a way that it's meant to go through those cycles and to not be overly reactive to short-term noise. So if that's not what is causing any changes in client portfolios, what is? As we start the year, we are going through a process that you're always engaged in, but happens in a very considered structural way in the beginning of the year, where we review all client portfolios. We try and incorporate market movements and changes in valuation. We try and incorporate changes in market conditions. We try and incorporate what you and your team have done with looking at managers and looking at specific funds, and then try and build that into client portfolios in as tax efficient a way as possible. So given that we're sort of very much in the throes of those thoughts and actions and so forth, maybe you can say a few things about what are some of the changes we'll start to see evolving in client portfolios and what's driving that if it's not the market noise.
Yeah, absolutely. It's we have these discussions, as you know, every month at the investment committee, discussing what's going on in markets. But we're not making big strategic changes unless there's a big change to long-term expected returns. Okay, and what has been interesting in the last year or so is that we have seen a pretty significant change in the expected returns for bonds.
Of course, right.
So for the longest time, we had very low bond deals.
Zero interest rates. Yeah.
No one wanted to be in bonds. Yeah. And people were looking at other ways to invest their money because they didn't feel that bonds were diversifying their portfolio. And that was understandable. But in 2022, we saw interest rates shoot up and bond yields went up, which means you can now get a much more attractive rate in CDs or in bonds. And so we discussed that at the investment committee, and we said, the bonds, they're worth taking another look at, right? So, and what we've been doing, I guess, over the last 18 months or so is we've just been tweaking things a little bit, just taking a little bit more bond risk. Which means if interest rates ever go down, that's going to be good for our bonds. Okay. And I mean, they've gone up a lot. The Fed is saying they're going to reduce by their own forecasts 3 times this year, which should be maybe a conducive environment for bonds. So that's what we've been doing. And the upcoming rebalancing, we will be doing a little bit more of that. So, and I'm very, very heartened that that's going to make the portfolio more robust over the long term, because, in environments where we do have a slowdown, and there's no imminent sign of recession.
There always will be
one. There will be one, right?
Yeah.
There will be one. And we're thinking of the long term. And in those kind of environments, if there's a recession or if there's some big event that frightens markets, our bonds typically do well in that scenario. So increasing your sensitivity to interest rates going down is a good way to insulate your portfolio, or at least mitigate some of the portfolio risk.
This must be so gratifying for you, because I can imagine it must have been so much harder constructing client portfolio asset allocations when the fixed income component was just a risk diversifier, but wasn't generating its own significant sort of return source in sort of zero interest rate environments. And now you have the ability to have that component of portfolios both act as a diversifier, which is important at the asset allocation level, but also have a role in positive contribution for expected return. That must be so much more fun to deal with.
It is. It's absolutely, it makes life a lot easier. So we have been increasing the sensitivity to interest rates, and it just is a natural diversifier to when bad things happen. Bonds tend to go up when equities are going down. That has been, it doesn't necessarily mean it'll always be the case, but there are scenarios, and that's what we're trying to cover off, is these big scenarios where that might happen, that you have some more protection in your portfolio. But the last 10, 15 years were tough when you didn't have that level of diversity, because nothing else really diversified to the same extent. There wasn't an asset class that you knew was going to do well in a recessionary environment on a consistent. Yeah, exactly. So yes, it's a much more beneficial. It's much more easier time to be managing multi-asset portfolios than it had been.
What are some of the other changes that we might start to see or continue to see as client portfolios are shifting?
I think we talked a bit about ETFs, exchange traded funds, before, remember? And so we talked a bit about all the advantages of exchange traded funds and compare them to mutual funds. We talked about their, in general, they tend to be cheaper. You can trade them at any time, and they can be more tax efficient. So, and the costs, of course. So all these things, these are nice, and these are good things to have in your portfolio. So, and that's why we have a lot of ETFs today in our portfolio.
Why wouldn't you want more? Yes, right.
So yeah, and we're moving there. Over the course of this rebalancing, we'll be moving more into ETFs. So clients shouldn't be afraid to see some change in their portfolios, but it's more about the vehicle that we're using, rather than that we're making significant tactical changes.
The underlying strategies are the same.
Absolutely, exactly the same. Yeah. So it's really just about the vehicle that we're using, and we're really excited about that. And I'll be more comfortable when we have more ETFs and less mutual funds. I think it's just the way to go. I think the industry is going that direction.
It seems that there are more providers making that shift, taking strategies that they only have in mutual fund form and creating ETF versions of them.
Do you think when we say ETFs that people still think of passive?
I do, unfortunately. I mean, for so long, an ETF was just an index tracker. That was for decades. I think that's what the concept is linked to. I do think there is a constant need to remind people that an ETF is a structure, not a strategy, not an approach to investing. It's just a wrapper, and how you use it says nothing about the letters on it, the ETF. But it's a little bit like, I remember the same conversation for decades about hedge funds. And people would say, well, what is a hedge fund? It's like, it's anything. It was whatever you put in the wrapper. So it could be someone just trading stocks. It could be incredibly sophisticated strategies. Hedge fund means nothing. It's just a structure. And what happens within it is whatever happens. And ETF's not quite as broad as that, but I think there's a similar education process that needs to continue.
Right. I think so. I think active ETFs, I think, are still pretty much in the early years. I think, but I wouldn't be surprised to see it gain in popularity. It makes a lot of sense. And I talked to people years ago about this, and many asset managers didn't want to do it. They said it's going to eat into our margins. Market forces have brought them there, so it's good for the end investor.
Which is what we're all here for. Looking further forward, are there areas that you would like to see things potentially evolve to? So this is a hypothetical that you can never actually answer with any specificity, but as you look at how you allocate time to research new managers, research new sectors or asset classes or what have you, are there areas that's like, I'd like to start to explore this. Clients might see us talking about these types of things in the future. Just sort of what's on your wish list?
Well, one of the things that we can do nowadays is, with the benefit of generative artificial intelligence, is we can do research more efficiently. And we're looking at ways where we can access research and summarize research more efficiently, more robustly, and that's something I'm excited about. We're going to be doing more of that.
That does seem to be such a dominant theme, and it's funny. We've talked about AI in the past as a market theme, in terms of driving the Magnificent Seven and so many sort of market high expectations about AI as an investment theme. It's really gratifying to hear it as an actual, working tool that has a specific positive effect, for our client.
Yeah, absolutely. Yeah, it's something we're quite excited about, because I think it's a natural benefit for those who work with lots of data. and we're dealing with lots of market data. So we're looking at better ways to code things, to analyze market, break it down, and in time to represent that to clients in a better way. So we're excited about how that's going to unfold.
Fantastic.